Let's talk about platinum prices. It's been a while since we talked about them, and last time we said that a break to roughly 1004 could lift us to 1128, a level that we reached, and then push substantially higher. Now, there is no specific pattern today that we're going to look at, but I'm going to show you how we could go along with a trend that is ongoing. And the reason for doing this is that it is summer, it's the 19th of June. And if you haven't already noticed, markets are really quiet, prone to have false breakouts. It's a time to trade less and effectively take a bit of holiday until something really big happens that gives us some direction. Now, let's talk a bit about what we discussed last time, and then we'll talk a little bit of how we can plan things going ahead. So this is inverse head and shoulders with a head and a left and a right shoulder, and we set a break here, could take you all the way up here. That happened for the break here, which happened on May 20th. We reached that target on June 5th. That's 16 days. Now, if you would have booked profits around these levels, then that would have been fully normal. Because if I would have gone long here, stop loss slightly below here, as discussed the first time, then your risk reward ratio have been 4.78. Now that's a really good setup, because many times what will happen is that you get this and then the whole thing comes back to entry. So if I would have got out here, absolutely perfect, because realistically it would have come back down towards the breakup point, but in this case, of course, it went ballistic. And it's gone even higher and higher. At the end, if one would still keep that position open, it would have been an 18.57 times reward ratio. So say, for example, you would have risked just 1% here, you would have made an 18% return, which is obviously a very strong move. And a move like that would set things like hedge funds. Do one trade like that per year, and then you're done. Now, what can we do next here? Because platinum and metals in general are just one of the few very markets that are still moving. Now, if we want to buy a dip, we need to identify the trend defining level. Where is the level that defines this whole structure? And to do that, we need to figure out this level here, or pinpoint this, which is the latest swing low. And as we can see here, it will be 1211. If we go now to the 4-hour, we could potentially reduce this, because we can see that we have another level here. So we could possibly work with this level here. Now, if we take Fibonacci from the low to the high, then normally you will go for a 50% correction. If you would do the same here, it will be the same thing. And I think what we can come to conclusion to that probably around here, around these levels, so 1,302, maybe in worst case a little bit lower, touching this level here, that would be the level where this market would probably look to bottom out. And we can always just take Fibonacci like this and get a confirmation. 50 is here, so this will be slightly less than the 50, but around these levels. And sometimes what we can do here, if we wanted to, we can even narrow it down even further. We can say like this: it's a very strong uptrend and hasn't really corrected too much in the past, which is obviously could be a bit of an issue, but we can go down, but we really shouldn't trade much lower than here. So when we start to think like that, then we can be like, oh, we could possibly reduce the risk a bit more and be like, it has to bounce from these levels. And here, we would allow the market to come down and see how it starts to react here, and then see if we can bottom out, say like having some bullish reversals here. Now, if we look for a target, we would look at something like the daily chart, and we can look here and see, all right, is there any major levels here that we can work with? Apparently not. This is the last high, and that's where we are right now. And this only goes back to 2015. So it makes it difficult for me to make sense of this. But I have something up my sleeve. So we're going to take that divided by US CPI, which is US Consumer Price Index. Because if you look at platinum prices, yeah, okay, they're back in 2015 levels. But we know that inflation since 2015, it's substantially higher. So if we adjust this by US CPI, you just click divide by US CPI, you would get this. And now you can see that we still have a bit more room to go In fact, when I did that, I even got pricing from a different company, and now I got even more data. So we still have quite a bit more to go. Now, from this perspective, if we focus on this level here, we can see that we still have a bit more to go to the prior high. And we'll take this, that will be an additional 15%. And then if we go to the actual high, it's another 23%. I'm not going to use this to figure out to place stop loss orders and TPs at these exact levels, because these levels are something you can't trade because this is inflation adjusted platinum prices. So say we go another 15%, then I can go back to the pricing here, I think markets, and then I can say, okay, I know we're above the actual 2021 high, but we're not above the true 2021 high because of inflation. That 2021 high is actually 20% away. So then suddenly you can see that we're looking for 1,618. Now that's obviously a very strong push, and we can now use this to figure out where to get out. And if one wanted to, for example, if one would have done some fundamental analysis of platinum, which I have not done here, and one had really strong conviction, then maybe one could say, okay, we're probably going to go all the way to these highs, and I'm willing to wait a month or so. So then suddenly you get yourself another very good reward ratio of 5.58. But probably what is better at this stage is to actually not be looking for that kind of move. Rather, it would be more prudent to maybe look for a 2 times risk reward ratio, something like this, where we would say, okay, we're going to go just here, book profits, and then we're going to look for the same setup again. We're going to look for the price to come down and then maybe look to buy again, okay? In other words, we want this like that, and then when we're here, we will repeat the process and say, okay, we are looking for a corrective move. And then if it comes down, we buy again and do like that. So those are two TPs there, whereas probably this one is the most reasonable one, but we still know from the big picture that this market has more to go. We also know that given that the markets overall are very quiet, and these are one of the few markets that are still moving, and this is something we want to focus on, unless we just wanted to take a little bit of break like everybody else and wait for the markets to start moving again. What's your thoughts? Share your comments below.